A tech YouTuber just dropped an urgent warning to all investors, and another one released a video literally called "Buy Now" on the same day. If that doesn't scream, this market is about to do something stupid, I don't know what does. You are watching the comment section with Thomas Paul, and today we're breaking down exactly what those creators are really saying, what it means for your money, and what you actually need to do now, before everyone else panic buys or panic sells at the worst possible time. Let's get into it. So why should you care about yet another warning to all investors and another buy now video? Because when serious finance creators start putting out messages that extreme, it usually means three things are happening at the same time. 1. The data is flashing bright yellow, maybe not full crisis red, but not everything is fine, go touch grass either. 2. Retail investors, you and me, are about to get emotionally whipped around by headlines, social media, and people screaming in all caps on thumbnails. And 3. There's opportunity, but only for people who actually understand what's going on instead of just chasing the latest "buy now" ticker someone yelled into a microphone. And here's where things get interesting. Both of these videos, from Tom Nash and MeetKevin, are looking at the same reality and coming out with what sound like opposite messages. One says, "Warning, be careful." The other says, "Buy now, this is your chance." But once you strip away the drama, they're actually way closer than it seems. Let's start with the warning. In his "Important Warning to All Investors" video, Tom Nash isn't telling you to sell everything and go live in a bunker with canned beans and gold bars. His core message is more like, hey, the party lights are still on, but the floor is getting slippery. Don't be the guy doing backflips near the edge. He walks through the usual macro red flags: elevated valuations, uncertainty about interest rates, the risk of a slowdown that Wall Street keeps trying to pretend will be soft and friendly, and the fact that a lot of investors are acting like the last few years didn't happen. In other words, people are getting complacent again. Risk is being priced like everything will just magically work out, because apparently we live in a Hallmark movie now. Tom's concern is that a lot of investors are piling into momentum trades, hyped up names, and story stocks without understanding the underlying businesses or the macro backdrop. Because nothing says disciplined capital allocation like buying a stock because someone on X.com said, "This is the next Nvidia" in all caps. He basically warns about a few key things. First, macro uncertainty. Interest rate paths, inflation trends, and growth are not settled. Markets are behaving as if the future is crystal clear. Spoiler, it's not. Second, valuations. A lot of companies are trading at prices that assume years of perfect execution. Any stumble? You're not just getting a pullback, you're getting an air pocket drop. Third, emotional investors. People who got burned in previous drawdowns, but now that markets have bounced, they're starting to feel FOMO again. Same playbook, new cycle. The warning isn't "the world is ending." It's "this is exactly the kind of environment where retail gets wrecked chasing the wrong thing at exactly the wrong time." But wait, it gets even wilder. Because at the same time you've got MeetKevin rolling out a video called "Buy Now," which sounds like the exact opposite take, until you actually listen to what he's saying. In "Buy Now," Kevin isn't telling you to YOLO your rent money into the sketchiest penny stock you can find. He's talking about a window of opportunity that opens when sentiment is confused, volatility is elevated, and people can't decide if we're heading into a soft landing, a recession, or some weird economic purgatory where everything is both expensive and fragile. His basic argument is this: if you wait for total clarity, you miss the best prices. By the time the economic headlines are "everything is safe now," the bargains are already gone, and the only cheap thing left is the YouTube comment section. He leans into the idea of buying quality assets, stocks, real estate, businesses, when others are fearful, hesitant, or just exhausted from the last few years of chaos. Using data, cycles, and risk-reward math to justify stepping in now, instead of waiting for the mythical perfect bottom that no one ever catches anyway. recognizing that some sectors and names actually benefit when the market is confused because they're still compounding earnings while everyone else is doom scrolling. And even though his tone is more aggressive, buy now is not exactly subtle. The underlying message has a logic to it. If inflation is moderating, if rates are closer to a peak than a starting point, and if certain assets have already repriced, then starting to accumulate positions now, gradually, can make sense. Here's the twist. Tom's warning and Kevin's buy now are not actually canceling each other out. They're describing two sides of the same coin. This is a dangerous market for gamblers and a potentially great market for disciplined investors. In other words, warning to gamblers, opportunity for adults. And here's where it gets really interesting for you. Let's bring these two together. Tom Nash is effectively saying, don't be reckless. Know the risks, understand the downside, have a plan. MeetKevin is saying, don't be paralyzed. If the math works, start acting. Waiting for zero risk is how you end up buying the top. So if you're an investor watching both of these, what's the message? It's not, go all in or go all cash. It's, you need a framework. Tom highlights the risk side of the equation. Rates may not fall as fast as people hope. Growth could disappoint. Earnings may come under pressure. Valuations in some areas look stretched, especially in hype-driven names. Kevin highlights the opportunity side. Certain sectors may be underpriced relative to long-term fundamentals. If inflation trends the right way and policy stabilizes, assets bought now could look cheap in hindsight. You get paid for taking risk when others are scared, if you're selective. So in practice, what does that mean for actual investors who aren't trying to become the next thumbnail billionaire? First, position sizing. This is huge. Both of these perspectives scream, don't treat every trade like it's a once-in-a-lifetime opportunity. You can build in tranches, buy in stages, leave cash available. You don't have to pick all in or all out. That's not investing. That's emotional roulette. Second, know what you own. Tom's warning applies especially to anything that only looks good on a YouTube thumbnail. If you can't explain how a company makes money, what its balance sheet looks like, and why its valuation makes sense under realistic assumptions, not fantasy, you probably shouldn't own it, regardless of whether Kevin says, buy now, or Tom says, be careful. Third, time horizon. Kevin's buy now perspective works only if you're thinking in years, not in, why is this position not up 30% by next Tuesday? If your time horizon is short, Tom's warning about volatility should be tattooed on your forehead, in reverse, so you can read it in the mirror every morning. But wait, you won't believe what happens when you put all of this into a practical playbook. Let's talk specific implications for investors, what you should actually do now, and what to watch next. Number 1. Accept that uncertainty is the default, not the exception. Tom's video is a reminder that macro conditions will always feel scary when you zoom in. Inflation, rates, growth fears, geopolitical noise, there's always something. Kevin's video is a reminder that if you only buy when everything looks perfect, you're volunteering to pay the highest prices. So your strategy has to work in uncertainty, not avoid it. Concrete moves? If you've been sitting completely in cash out of fear, you might start building exposure slowly into quality names or diversified ETFs, instead of waiting for the mythical crash of the century that may never come in the neat cinematic way people imagine. If you're already fully invested in speculative stuff, Tom's warning is a big red flag. Maybe trim the riskiest, most overextended positions. Move some chips from the casino table to the boring, profitable, cash-generating corner. And yes, I know, boring and profitable is less fun than 10 times in 10 days. So is flossing. But both tend to work long-term. Number 2, watch the macro triggers, but don't worship them. Both creators are essentially anchoring on the same big levers: inflation data, interest rates, earnings, and growth. You should absolutely keep an eye on things like, are inflation readings trending down consistently or stalling? Are central banks hinting at cuts, holds, or more hikes? Are corporate earnings holding up, or are we seeing broad-based cracks? Are consumers still spending or starting to pull back? But here's the catch. By the time those signals are crystal clear, the market has already moved. So instead of, "I'll only invest when the coast is clear," think, "I'll invest knowing the coast is usually foggy, and I'll build that into my risk management." Number 3. Know the difference between buy now and buy anything. MeetKevin's framing is opportunistic, not random. It does not mean, "Every stock is cheap, slam that market buy button." In a confusing macro environment, dispersion usually increases. That means some names and sectors get crushed more than they should, and others stay overpriced because they're trendy. Opportunistic investors look for companies with strong balance sheets, real cash flows, or clear visibility to profitability, valuations that assume reasonable, not magical, growth. Sectors that benefit from where we're headed, not just where we've been. Tom's warning dovetails with this. If you're buying something whose only thesis is, "It went up a lot before, so it will go up again," you're not investing, you're reminiscing. Number 4. Control what you can actually control. You can't control inflation. You can't control the Fed. You definitely can't control what some hedge fund does at 3:59 p.m. on a random Thursday. But you can control your allocation to risky versus stable assets, your use of leverage. Hint, in uncertain times, margin is like juggling knives on a unicycle while drunk. Your behavior when prices move against you. Tom's warning is aimed at the emotional side. Don't let greed and fear drag you into dumb decisions. Kevin's buy now is aimed at the paralysis side. Don't let fear keep you in cash while good opportunities pass you by. The adult move is somewhere in the middle. Have a plan, execute it gradually, refine as data changes, but don't constantly flip from doom to euphoria based on the headline of the day. And here's the key thing to watch next. Keep an eye not just on economic data, but on sentiment. When every thumbnail screams urgent warning and everyone on social media is convinced a crash is imminent, that's often when the market quietly grinds higher and makes the patient look smart. When every thumbnail says, "Easy money, buy now, no-brainer," that's when Tom's warning about overconfidence becomes your best friend. Right now, we're in this awkward in-between. Some people are terrified, some are euphoric, and a lot are just confused. That's exactly the kind of environment where disciplined, boring, dollar-cost averaging, fundamentals-first investors quietly build positions that look genius 5 years from now. But hey, boring doesn't get the clicks until it does. So what should you, personally, do now? First, audit your portfolio like an adult. Look at every position and ask, if this dropped 30% tomorrow, would I be a buyer, a holder, or a panicked seller? If the honest answer is panicked seller, that position is too big, too speculative, or both. Tom's warning is basically, figure that out now, not during the next flush. Second, if you have zero exposure and you're sitting in fear, consider staging in. Buy a little now. Buy a little more if we get a pullback. Buy more if the thesis improves and the data supports it. That's basically the rational version of buy now, not go all in today, but start acting like an investor instead of waiting for a perfect setup that will never arrive. Third, turn down the emotional volume. You can watch macro videos. You can listen to creators like Tom Nash and MeetKevin for perspective, but your decisions should come from your plan, not their thumbnails. They provide information. You provide discipline. And yes, this is the part where I remind you, nothing you heard today is personal financial advice. I am not your financial advisor. I am the slightly sarcastic narrator in your browser window. But if you take anything away from this, warnings and buy now signals are not contradictions. They're two different ways of describing risk and opportunity at the same time. Your job is to manage both. All right, let's land this plane. If you've watched multiple "The Crash is Coming" videos and multiple "This is the buying opportunity of a lifetime" videos, and you're still stuck, here's your simplified checklist. 1. Don't be over-leveraged. If you need margin just to feel invested, you're doing it wrong. 2. Don't own things you don't understand. If the company's business model sounds like a word salad, pass. 3. Use time to your advantage. Dollar cost average into quality, and let volatility work for you instead of against you. 4. Expect the market to try to shake you out. That's basically its entire personality. If you found this breakdown helpful, here's your action item. Drop your hot take in the comments. Are you in Tom Nash mode right now? Defensive, cautious, tightening risk? Or are you in MeetKevin mode, looking to deploy and buy this confusion? Or are you, like a responsible adult, somewhere boringly in the middle? I actually read the comments, and yes, I will absolutely roast the worst takes in a future episode. Lovingly, of course. Make sure you hit subscribe to the comment section with Thomas Paul, turn on notifications so you don't miss the next breakdown, and if you want more deep dives into the weird intersection of money, markets, and internet hysteria, you know where to find us. Thanks for watching, manage your risk, don't chase thumbnails, and I'll see you in the next one.